Hello everyone, today I'm going to talk about one chapter from your economic book, which is Open Economy Basic Concept. In this video, I'm going to cover all the key concepts and variables for open economy interaction in world market. You may already know the variable like export, import, trade balance, net capital outflow, and exchange rate. Actually, we're going to look at why a nation net export must equal to net capital outflow. And finally, we talk the exchange rate. So let's get started. Basic concept. In development of macroeconomics, we can distinguish between closed economy and open economy. To keep economic model simple, macroeconomists often assume a closed economy. A closed economy is an economy that doesn't interact with other economies in the world. It means there are no imports from other country and no exports to other country. So formula for closed economy is Y equals to household consumption plus investment plus government expenditure. And macroeconomists also study an open economy. Open economy is defined as economy that interacts freely with other economies around the world. This means that an economy has a relation with the rest of the world. It conducts trade with the rest of the countries, so it has imports and export. The formula for open economy is similar to closed economy but adds with export and import. The difference between export and import is net export. For this chapter, we just talk this open economy. Open economy interacts with other economies in two ways. First, buys and sell goods and services in world product market. Second, buy and sell capital asset in world financial market. First, we look the meaning of export and import of goods and services. Export are goods and services that produced domestically and then sold to someone in foreign country. Export lead to an inflow of funds to the seller country since export transactions involve selling domestic products to foreign buyers. Export are one component of international trade. The other component is imports. Imports are defined as the goods and services that produced abroad and sold domestically. That means import goods and services that are purchased from a country resident rather than buying domestically produced items. Imports lead to an outflow of funds from the country since import transactions involve payments to sellers residing in other country. For example, Indonesia became a major supplier of agriculture products for international market. When Indonesia produces agriculture products such as palm oil and rubber products, then sell it to many countries of destination, the sale is an export for Indonesia and import for importing countries of Indonesia. Combine the difference between a country value of imports and value of export, it's called net export. Based on the formula, we look the net export of a country is the value of export minus the value of import. It also called the trade balance or commercial balance. Net export is one of the components in gross domestic product. Because export is the trade balance, it allows us to determine situation of surplus, deficit, or equilibrium in a country's relation with the rest of the world. Depending on whether a country imports more goods or exports more goods, net export a country can be a positive or negative value. If net export are positive, there is an excess of export over imports, indicating that the country sells more goods and services abroad than it buys from other countries. In this case, the country is said to run a trade surplus. On the other hand, if net exports are negative, which means that exports are less than imports, indicating that the country sells fewer goods and services abroad than it buys from the other countries. In other words, there is an excess of imports over exports. In this case, the country is said to run a trade deficit. And if net exports are zero, which means export and import are equal. So the country has a balanced trade. So far we have discussed how open economy in world market for good and service. And now we're going to discuss open economy for financial market. The meaning of net capital outflow refers to the difference between the amount of foreign asset bought by domestic resident minus the amount of domestic asset bought by foreign. Based on the formula, net capital outflow is purchase of foreign asset by domestic resident minus purchase of domestic asset by foreigners. For example, the purchase of foreign asset by domestic resident, which is like Indonesian resident buys stock in US company and it will increase net capital outflow of Indonesia. Meanwhile, the purchase of domestic asset by foreigners, which is like a US resident buy a bond issued by Indonesian government, the purchase will decrease Indonesian net capital outflow. If we talk about the flow of capital, the capital can move from one country to another country because there is a purchase of one country asset resident to another country. The capital can divide it by two forms, physical capital investment and financial investment. Example for physical capital investment is foreign direct investment. Foreign direct investment occurs when a capital investment is owned and operated by a foreign entity. For example, McDonald's opened up a fast food outlet in Indonesia. That is an example for foreign direct investment. Alternatively, example for financial investment includes a foreign portfolio investment. Foreign portfolio investment involve investment that is financed with foreign money but operated by domestic residents, such as stock and bonds. You can invest your money in capital asset like stock to gain income from dividend payment. In this section, we discuss the equality of net export and net capital outflow. If we look on the screen, net export and net capital outflow are closely linked. It because net export and net capital outflow measure a type imbalance for their each market. Net export measure imbalance between a country export and import. Meanwhile, net capital outflow measure imbalance between the amount of foreign asset bought by domestic resident and the amount of domestic asset bought by foreign. So as a whole economy, net export and net capital outflow must balance each other, so that net capital outflow equals to net export. If net capital outflow increase, then net export will increase by the same amount too. This can happen because every international transaction involves an exchange of assets for goods and service. So, an economy net capital outflow always equals its net export. But sometimes net capital outflow can be either positive or negative like net export. For example, when net export is positive or a nation running trade surplus, it means economy selling more goods and services to foreigners than it's buying from abroad. In other words, export exceeds the import. From the net sale of goods and services, the domestic resident will receive foreign currency, and then they use foreign currency to buy more foreign assets. So the capital is flowing out the country, and it means there is a capital outflow, or net capital outflow is positive. A positive net capital outflow also means that the country invests outside more than the world invests in the country. This is a case for negative capital outflow, means the opposite. For example, when the export is negative or a nation running a trade deficit, domestic economy buying more goods and services from foreigners than it's selling to abroad. In other words, there is an excess of imports over export. So the net purchase of goods and services is financed by selling assets abroad. It means foreigner will buy more domestic assets than the domestic resident buy less foreign asset. The capital is flowing into the country, and then the country experience a capital inflow, or net capital outflow is negative. This is the relationship between saving and investment to international flow. We can look on the slide. Uh, GDP is the sum of four components: consumption, investment, government expenditure, and net export. And then if we put the consumption and government expenditure to the left hand side, it becomes a national saving. National saving is equal to the income of nation after paying for current consumption and government expenditure. And then if we rank this formula again to put investment to the left hand side, and the result is net capital outflow equals to net export or trade balance. Because net export and net capital outflow are equal, we can rewrite the formula to this look. This formula implies saving is equal to the sum of domestic investment and net capital outflow. For example, if you have a saving, you can use your money to finance accumulation of domestic capital or use to finance the purchase of capital abroad. If you have ever traveled out from your own country, you probably have some experience with exchange rate. For example, if you are Indonesian and you travel to America or another country, as soon as you arrive in the foreign country, you must acquire some local currency. If you go to ATM and stick your Indonesian ATM card, in there you're going to end up getting some cash out that isn't equal to the amount of rupiahs that you have give up in order to get that cash. Well, what you experience when you take money out from your bank account in another country is the exchange rate. So the exchange rate is the value of one country's currency expressed in the term of another country's currency. And the exchange rate are determined just like the price of most things are determined in the marketplace. The market in which exchange rates are determined is known as the foreign exchange market. So foreign exchange market is where currency are bought and sold and exchange rate are determined. As we begin discussing exchange rate, you may have always wondered how do nominal exchange rate and real exchange rate differ? Well, the nominal exchange rate is rate at which a person can trade currency of one country for currency of another. For example, when you go to the bank, you may see a post exchange rate of 80 yen per dollar. If you give the bank $1, you will receive 80 yen in return. And if you give the bank 80 yen, you will receive $1. In economics, you can use appreciation and depreciation to describe the change of exchange rate. Currency appreciation is an increase in the value of a currency comparing to another currency. It means that one country is capable of buying more foreign currency than before. If a dollar buys more foreign currency, there is an appreciation of dollar. In the other hand, depreciation is a decrease in the value of a currency. If a dollar buys less foreign currency, there is a depreciation of dollar. For example, when the exchange rate rises from 10,000 rupiahs to 13,000 rupiahs per dollar, dollar is said to appreciate. And at the same time, rupiahs is said to depreciate. The real exchange rate is more complicated than nominal exchange rate. The meaning of exchange rate is rate at which a person can trade the goods and service of one country for another the goods and service. The real exchange rate determines how much a country exports and imports. For example, if American rice is a half as expensive as Japanese rice, the real exchange rate is 1 per 2 Japanese rice basel per basel of American rice. We can calculate the real exchange rate with the following formula in this slide. The real exchange rate is nominal exchange rate multiply domestic price and then divided by foreign price. From this formula, we look the real exchange rate depends on the nominal rate and the price of goods in two countries, domestic and foreign price. Goods measured in local currencies. In this section, we're going to figure out the change of exchange rate in United States. Depreciation or fall in the US real exchange rate means that US goods have become cheaper relative to foreign goods and services. This change encourages at home and abroad to buy more US goods and fewer goods from other countries. As a result, higher export and lower imports for US. Both of the change can raise net export of US. Conversely, an appreciation or rise in the US real exchange rate means that US goods and services have become more expensive compared to foreign goods and services. This change encourages consumers at home and abroad to buy fewer US goods and more goods from other countries. As a result, lower export and higher imports for US. And both of these things can make US net export fall. Thank you for watching this video. Hopefully this helped you better understand the basic of open economy. Happy practice and see you.